Welcome to our Rio meetup Thursday, 7 p.m. Eastern Standard Time. All these recordings will be available on our YouTube channel afterwards, a couple days maybe. But all previous real estate accredited recordings are available right now. So if you didn't know, yeah, welcome. And today we're going to go over a topic of discussion, which is acquisition process. Very exciting topic. And feel free to ask questions throughout. But Philip, go ahead and get started. Thank you.
All right. Thank you, Jeff. Welcome to Real Estate Accredited, our Thursday educational hour, 7 p.m. Eastern, as Jeff mentioned. So today we want to talk about the steps, part of the acquisition process, the steps to make an offer on a multifamily property. As usual, we focus on in-place commercial multifamily value add. That's our bread and butter. And Jeff and I, we are the co-founders of Boost Capital Group. Let's start. And number one, in order to be able to make a serious offer, you're going to need a few things. Number one, obviously, the deal flow. You're going to look at multiple properties, multiple opportunities that come across your way. They could be either on or off market. And typically, deals would come from brokers. They also can come from directly talking to owners, which is a little more challenging, but still possible. On all of these deals, you're going to need to have the financials, trailing 12 months of operations, as well as recent rent roll. And it's optional, but always useful, especially from big real estate brokers out there, the offering memorandum that is going to give an overview of the deal. Number two, or I guess second major bullet point here, you're going to need an underwriting model. That's out of the scope of tonight, but obviously when you're going to put your numbers together, you need some kind of way to model how you think the operations will look like going forward. Also, next, you're going to need a market report. I like the CoStar reports. Sometimes the Yardi is also a good resource. And CoStar is the golden standard, in my opinion. You can always ask the real estate broker to provide that to you, and they should be able to typically provide that to you. And finally, you're going to need a team of third parties. I also already mentioned the real estate broker, but you're going to need a very important key partner with you on the deal, that is the property manager. You're going to need a loan broker or lender, direct lender, an insurance broker, and a real estate tax attorney, but by default, the county or city assessor's office. And just I want to take, since several people joined just now, tonight we're talking about the acquisition process and the steps to make an offer on a multifamily property. We just went over the prerequisite, and now we're going to move to the overview of what it takes, right? To make an offer, you're going to underwrite deals, and based on this underwriting, you'll be able to come up with a purchase price. But let's review the different steps. So number one, you're going to review the financial statements. Then you're going to work on understanding the location, the neighborhood, and demographics. Study comparable properties for the potential post-renovation rents. Then define a pro forma for the whole period. Also define high-level capex estimates to make sure that you have all the information you need for your underwriting. Also find debt information, and finally work on splits, target returns, and define your purchase price. So we're going to go through these 7 bullets a little more in detail. As a note here, and I know that's something we addressed in one of our prior calls, but I would say to do a rough analysis, it can take 2 hours. If you're looking at properties in the same area and that are similar in size and vintage, you can certainly go much faster because you're going to have all the information available for the other property. But if you start, let's say from scratch, it's going to probably take about 2 hours. And then when you fine tune everything, it may end up, you may end up spending at least 20 hours on the different areas here to bring that deal to an LOI or letter of intent ready stage. So reviewing the financial statements. And by the way, so if anyone has a question, don't hesitate to ask. Otherwise, we can take the questions at the end. It's not a problem. So reviewing the financial statements. So you've obtained the trailing 12 months of operations, and you're going to look at 2 things. Based on these past 12 months, you're going to focus first on the past 3 months and look there for the gross potential rent that was achieved by the property, vacancy, concessions, loss to lease, bad debt. Those are all numbers that you're going to want to look for, because basically anything pertaining to vacancy, concessions, loss to lease, and bad debt, that's where you're going to start after acquisition. Similar, more or less, story for other income that could come from charging washer and dryer, for instance, preferred parking, or RUBS, which is charging for utilities. You want to know how the property has performed. And right now, the goal is to look at the rear view mirror and look at the operations to date. Similarly, but on the expense side, you're going to focus on the full 12 months. And why you want 12 months? Because you want to have all seasons of operations for the property. You cannot only look for the past 3 months, because past 3 months will be tied to that particular season, which may not be representative of a full year.
Yeah,
There you're going.
also to point out, and maybe I'm stealing some of your thunder here, but the 3 months would be more for the financial assessment by the bank. They want to see the last 3 months of income, not so much the 12 months. So there's that disconnect there with you want to see the 12 months of actual operations, because you could squeeze in a lot of new renters and increase those prices, but within those 3 months when you're ready to sell. But the bank wants to see the 3 months, and you as the investor slash operator wants to see the 12 months, because you want to see the disconnect on how things may have shifted, changed, or new contracts being added last minute or taken off. Because if, let's say, the renters were provided in internet, for example, or cable as part of their rents, and then they took it off at the end to try to lower those expenses, then there's some issues that you want to look at old contracts and make sure that these people did not sign up with those kind of incentives. Those are little things that can be easily overlooked and amount to a large amount of expenses when it's time to take over the property.
And here, while you are taking, I just wanted to, I didn't focus a lot on illustrations today, but just to give an idea of basically the T12 trailing 12 months, it's an Excel spreadsheet. A lot of numbers. I didn't capture the whole thing, but it's what you have to go through to understand the different income and expenses, fees and whatnot. I'm just going to skip. Those are the typical categories of expenses. There's not much value, I think, to go one by one. But the idea is to basically sort through the information available in the trailing 12 months of operations and bring the different lines under different categories. So you see here, I have many lines. This particular file has 71 lines, actually. And you're going to break it down in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 categories, right? So you're going to arrange everything, and it gives you like an overview of the past operations. On the rent roll side, similar to this, just a list of all the units and what rents they're being charged. You're going to want to look for the current average rent per floor plan for the different floor plans. Also, if it's applicable, you want to look at the different or average rents for renovated units. Also, double check the vacancy, make sure it's in line with the vacancy of your training 3. And if available, take a look at the bad debt, meaning that's for tenants who are behind in paying their rents. And you don't want necessarily, I know last year we are looking at partnering on a deal, and based on the amount, of bad debt, we decided not to move forward because there just was too many tenants who are behind on rent.
And just to touch a little bit on the vacancy, keep in mind that there's certain markets that have average vacancies. So that's a good data point to compare the asset that you're looking at or that you're investing in, what the average vacancy is in that market compared to what the actual vacancy is at that property. If the difference is too great, then it's time to ask questions like, why is it so much lower? Is it that people are just not wanting to move in there? Is there issues with the current management? So there's a lot of things to look at, but that's just a data point to look at. Compare the vacancy of that specific asset to the vacancy of that market.
Yeah. So I'm just bringing a rent roll for illustration as well. And we can move on. All right. So my second step is you want to understand, and I think that's also, I should have mentioned in this on this page what Jeff mentioned. But you want to understand the location, the neighborhood. You also want to understand the demographics. So the first step is really, if you don't know the city, particularly if you're going to invest in a city that you're not as familiar with, you're going to want to discuss with the broker, ask them about the property, the neighborhood, and you'll see in the 3 questions coming up. But the broker is a good resource. You can use the offering memorandum. Usually we'll have a lot of information about the neighborhood and potentially demographics. But take also the opportunity of the property tour. I think it's probably an important step of when making an offer. You want to understand a little bit, see how the property looks, see how the neighboring properties look, and what are the different stores and restaurants nearby, which is my second bullet here. You want to have an understanding at the end of the day of why tenants will pick that particular property. Why is it attractive for them? And also another thing, maybe it's less obvious to do when you do just a tour. It's better to talk to people who are familiar with the area. You want to have an understanding of who are the key employers in the area. And all of that in line with what's the class of the property? Is it in bad shape, good shape, medium, brand new? Class ABC, basically. And same thing for the neighborhood. Ideally, you want to buy a property that is in not great shape, in a great neighborhood. Obviously, it may not be that easy, but you need to understand the neighborhood and the property and how the property fits in the neighborhood. Then use the market report to check that the median income, and that's more for the demographics, median income is in line with your rents. You want the median income to be greater than 3 times your target rents, right? That's another example. Again, think about last year as well. We were considering a deal, and at the end of the day, the demographics, the median income didn't support the target rents. We decided to pass on that particular deal.
Really, Leslie has a question or partial statement in regards to RUBS that she said, I think I prefer that tenants have to pay their own water and utilities. Some seem to prefer the opposite, to charge the tenants more money. Isn't it just simpler to have the tenants pay? Obviously, it is a lot simpler because rubs cost money also to manage and depends on the property. As you probably know, some properties are just not broken down to individual units. So when the property is on like a master meter or something of that nature, then yes, rubs is a requirement. I agree with you. I prefer the tenants become responsible for their own utilities and it simplifies things because if they don't pay, that's another thing with rents and no pay of they're just adding that to the rent. And then it's just they're more liable to spend more in energy and water because sometimes either A, it's part of their rents or if they're being charged rubs. And I think there's some kind of, I don't know the specifics on the rubs as far as what you're able to charge as far as a percentage, but obviously it's not also something that you can do in every state.
Yeah, it's different state or possibly counties actually. All right, so we spoke about the median income. Finally, here on this page, you want to have an idea of the cap rate or capitalization rate. Very important number that helps you make the relationship between the net operating income, which is income minus expenses, and the value of the property. So for instance, if to keep it simple, cap rate is at 10%, it means that NOI, net operating income, divided by purchase price is going to be a factor. No, actually, it's the other way. The price will be 10 times the NOI in that case. It's a very important number to understand and to have an idea of. And usually have that discussion with the broker. If you can find other sales, obviously that's a good other source. And once you have this cap rate, usually good practice is to add 0.5 to 1% to the current market cap rate to anticipate any expansion of cap rates. And we spoke about that in a prior call, but the net effect of the increase of interest rates, there was an effect of cap rates that expanded. It's a good example of the application of why it's a good idea to add some 0.5 to 1% to the market cap rate to anticipate or to be ready in case the cap rates increase. All right, next, you're going to want to study comparable properties, right? So your goal there is to find what are the rents at comparable properties, what are the rent comps. And I put three layers, three levels here. High level, you can use a tool like rentometer.com or Bigger Pockets. The Pro version has a rent comps tool, so similar to Rentometer. Unfortunately, Rentometer, you can do only so many free estimates. And after, it's going to ask you to pay for it. So that's why I give biggerpockets.com Pro subscription as a similar tool. The next layer, a little bit what I call the detailed analysis. You want to use apartments.com or rent.com and the offering memorandum to identify your competition. So the idea is to pick or identify 4 or 5 properties that are in the same neighborhood, similar vintage, similar size, similar renovation level or better, actually to your target renovation level, and similar amenities. And then again, once you've identified these properties, you can check the rents online at the same websites. And sometimes if there is a property website, you can also check the property website. There could be a lag on these other websites. It doesn't necessarily reflect the latest and greatest concessions or just rents in general. Finally, and I would say that's just kind of something that you want probably to do for sure during due diligence, meaning that after you have an LOI signed, a letter of intent signed, or even once you are in the contract, but you're going to want to shop these comps in person and just have a feel how your property is going to compare to the other properties. Next step is going to be to work on the pro forma, and that's where you're going to to use your underwriting model. So first you're going to review the rents and also define the renovation scope and that will allow you to achieve these rents, right? Because let's say you have your rents are at 1,000, you feel the competition with renovated units can do 1,200, so you're going to use in your pro forma, okay, my target is to reach the $1,200, for instance, for rent, right? So you're going to review the rents, the renovation scope, income assumptions in general, and I should have said other income, with the property manager that you plan to hire in case you close on this acquisition. Similarly, on the expense side, talk to the property manager, look at all the categories I mentioned before for the T12, and maybe you will have, at that point, you may have the T12 information as a baseline, but you can use rules of thumb from the property manager. You can use also maybe the input from the offering memorandum to compare and contrast the different numbers, but have a discussion with your property manager on the expenses, including the utilities and trash removal. They may have an observation that it appears to be too high. Always good to ask them their opinion on this. Also, you're going to define an income and expense escalation for every year of operations. On income, going back to what Jeff mentioned earlier, when you understand the market, you're going to use maybe like the market report and see what kind of forecast they have on the rent increase. It's a good CoStar reports. They always have a forecast, but also discuss what you plan to use with a property manager as well. And on the expense side, for the escalation, you can use usually between 2 and 3%, which is inflation. Next, you're going to ask an insurance broker for an insurance quote, at least a soft quote, meaning like an idea of how much the insurance will be, because insurance, as I always say, it varies a lot and it varies often. And you probably heard in the past few months, in the past year, insurance increased quite a bit in some areas in the country. Finally, talk to a real estate tax attorney to understand what to expect for taxes, real estate taxes. It may make sense, it may not. If it's a smaller property, maybe just understanding how the county or city is going to assess the transaction and know like what numbers, what formula they use might be enough. But on a larger deal, you're going to certainly want to talk to a real estate tax attorney with the idea that they would go back to the assessor's office if those taxes were too high. So those always interesting to have a conversation with a real estate tax attorney. We're almost there. High level capex. Sorry. We're talking about value add. So we have a property that we can do renovations, bring it to a higher level, increase rents, we increase the value. That's the basic premise of doing the in-place multifamily acquisition. So you're going to need to have a budget for capital expense budget. And here are the things to consider. First, have a discussion with the broker and the owner or the owner if you're talking directly to an owner. And what you want to know there, is there any deferred maintenance? right? Because realize you're entering a business relationship, at least for the length of the transaction, and anything that they know, they have to disclose to you, right? And then if they don't, they couldn't be at fault. And then you have also to think about, let's say down the road you discover something that they didn't know, and say, okay, I didn't know about this, for instance, sewer lines that are made of cast iron at the end of their useful life, and there are many holes in those. When you put some cameras, that's going to be an expense. And maybe they didn't know. That it happened to me, actually. They didn't know, but we said, oh yeah, look, it's a property from the late 60s, and there will be potentially issues with the sewer lines in cast iron. And sure enough, we found problems. Here you have to understand the condition, general conditions. Is there any known deferred maintenance? And if it's, even if it's unknown, then you can go back to the seller and say, when we did our inspection, we found this and that, and now the price doesn't make sense anymore.
This is a good segue real quick in regards to the capex and having a contractor. There's a little bit of a side discussion about when to bring a contractor or things of that nature. So when one of the properties we looked at in, was it Atlanta, the property management company had their own contract company, so to speak, and they charged us to walk through the property. But it was a reasonable amount based on all the requirements.
Well, it was an inspection.
Right, yeah, it was an
It was an
inspection.
inspection, yeah.
So, which kind of segues into what they're willing to do in regards to saying, hey, we want to bring these properties to a higher tier aesthetics wise. And so they're able to better have an idea of this is what's going to cost us in this area to bring it to that. But there's that, because I think Paula said she had somebody drive 3.5 hours, a contractor. But if you're working with
We
a
had
property
someone who
management
offered.
company, what's that?
We had someone who offered
Off-
post the visit.
Oh, okay.
That's what happened in that. The deal closed in a week and we didn't get a chance to go back.
Okay.
It was really fast.
Yeah, so sometimes, the property management company that you're working with has inspections that they can be pretty thorough. I mean, we had a couple of reports that came out of that. It wasn't incredibly expensive overall because I'm sure a lot of the issues that are overlooked may cost more than that inspection. So there's different ways to approach that. It doesn't have to just be a contractor that specifically from a different area.
Yeah, and that's just to be clear, right now at this stage where you are in the process of making an offer, you're not going to pay for an inspection. So that's where it makes sense to bring somebody with you who has more hands-on experience. And on that particular deal that Jeff mentioned, we brought, actually, there was, because it was part in place, part new construction, the developer for the new construction, they said, oh, we can do also renovations. And they came with us when we did walk the property initially, and we started to develop this high-level capex budget at that point with that particular. So we use other words we use like a third party, a contractor in that particular case, to start developing a high-level capex budget.
Can I ask a question?
Sure.
Okay, so the question is directed to both you and Jeff. So in a situation where I would be driving out of town 2-3 hours, whatever it is, and let's say I can call a property management company, Jeff, in regards to what you just said, if they do have a contractor or their own inspector, in that situation, should I be able to expect a report, maybe not as detailed as an inspection report, or is their person going to meet me there and just say things and I take notes on them?
It depends on the agreement. If you're at the beginning stages and you're just doing an initial, chances are they're not going to do a full-blown report. It'd be good to have them point out issues that you can start formulating an idea of what the capex, which will then help you make your offer. Then you have your due diligence period where you go in full detail trying to identify all the issues that you may come across. And there you spend some money with getting a full-blown report of what the findings are. But I wouldn't say that you're spending money at the beginning. Some may tell you that, oh yeah, we'll charge you to go out there. But it just depends on where you are with the LOI process and the acquisition process. Just remember that most of your work is going to be done, the analysis up front, but the thorough part is once you're closer to getting that contract, you're negotiating that LOI, and you feel like you're gonna go move forward, you start getting those people in line. So day one, you get on the ground and you start going through that with a fine-tooth comb.
Okay, and then so with this being the first one that would be out of town, are the PMs, is this something they're willing to do because it is an additional or supplemental service that they have as an income stream, or are they doing this mostly, or I'm trying to make it mostly because they want me to sign up with them, whereas
Yeah.
I just want two people there, a property manager who may know the area, but also their knowledgeable contractor who can give me information about the improvement itself. And I don't necessarily know that I want that property management company though.
Mm.
That's a tough situation because they're looking for clients as well. They're a business, and they won't necessarily come out of the good of their heart to just do a free analysis. They want to be able to know that you're going to work with them. So it's always good to talk to these companies before you really commit. So once you find a property and trust that you're going to work with that property management company, so you're not jumping back and forth trying to find because you want somebody to do an analysis of telling you, yes, we're going to be able to increase those rents to this much. We are in the same line. We agree with your underwriting, and so that you guys are on the same page. But to do that with multiple property management companies, it becomes a little bit of more work for you ultimately. I don't know if I answered your question.
I do, and I think this is honestly my last question, I promise. So if this is in fact a situation where I'm trying to parlay with them, get a discussion going, they understand that I need someone to help me perform my analysis. I don't own the property. If I don't own it, I can't necessarily already agree that, hey, yes, I'll give you the business. So I would need them to very much understand I don't own it, but I'm looking to see whether it is in fact a viable property for me to purchase. And if so, my thought would be based on preliminary interviews, I probably would give it to them. Now, if that's the case, prior to me closing on it, are they able to say, yes, this is what we're going to charge you? This is what, if there's maintenance for on, are they going to be able to do all that, or does somehow that number change after I close?
That a lot of that information would be handled before the property closes. You have a percentage of what they're going to charge you per unit, and then you came to some type of agreement of what the capex per unit would be. So it's not going to be an exact science. There's going to be a little bit of deviation from the original number. It's not going to be perfect because it's like trying to, through a crystal ball, identify what your vacancy is going to be, or like when are you going to be able to turn another property? It depends on when the next people get evicted or move out. You can get as close as you can based on those numbers, on your underwriting, on your analysis, and it'd be a matter of agreeing to those numbers as best as possible. So it's not, once you sign a contract, as far as percentages that you're gonna pay them out of the income, and then additional services that they're going to provide for you, how many people are going to be working at the property, if you're going to have an on-site management versus on-site and another portion of just overall management. So there's a lot of different things that you're gonna have to work with them on the contract. I don't know if I answered your question on that.
I think it's a really impregnated question, so I probably just need to narrow down what my thoughts are before I approach a PM, because I think they're like these, I don't know, it sounds like there's multiple facets of it. Like when you're just doing it yourself locally, you don't even have to worry about this. But when you say, okay, I'm going to bring somebody else in, and I'm bringing somebody else in who I can't put a finger on by just driving down the street 40 minutes, it just makes me very nervous. But my market right now is too expensive, so I need to start exploring going out.
And just one more thing, not all PMs handle all size multifamily, for example. Some only go 100 and above, or some do just 20 to 50. So there's little niches there as well. So if there's a company that just been doing 50 and you got a 100 unit property, that's probably not your go-to because you're going to be the first 100 unit property. So there's also that perspective.
Yeah. And I'll be small, like C class 5 to 20, because this will be my first multifamily.
Yeah, okay. Yeah. And like Andrea said, don't burn bridges. Don't try to stick to a team you feel comfortable with so that you're not having these people do work and then you end up going with a different, because essentially if you're working in that market, you're going to probably need them because the one you go with may not be the best fit after all, and you might have to go back to them. So it's always good to narrow down your team because they're going to be part of your team ultimately.
Good question. Good question. Okay, so I think it was a good discussion and we more or less covered the other bullets, but real quick, when you walk the property, you're going to assess the conditions of whatever is visible. And for example, roofs, building, the exterior of buildings, landscaping, parking lot, the amenities, and also you're going to be able to assess, hopefully during that walk, the classic and renovated units, if any. And again, if you have, the idea is to walk the property with a property manager or contractor, someone who can help you start defining a budget for the different things, or you just take pictures and then you can have a conversation after the fact. That's worst case scenario. But based on the target renovations, it's always always good to ask the broker their opinion. They're going to have an idea of the scope of work. Also the property manager, what they've seen. Maybe do you want to do granite countertop or just the regular Formica type of countertops? Do you want carpet or LVP, luxury vinyl planks? There are so many options out there, and you want to be able to fit your market at the end of the day. That's why it's good to have those discussions with the broker and the property manager. And as I mentioned earlier, you're going to work also the comps to have make your own idea. And finally, I put property manager, it could be a contractor, for a rough estimate on the renovation costs. Either, like we mentioned earlier, when you walk around with them, you say, oh, what about this? How much? And just do a list of all these expenses. At this stage, the idea is to have a high level capex budget, right? You're not trying to be 100% correct. You want to make sure that you have enough to cover what you can see and maybe leave a little bit of a margin there. Next, the debt. That's a very extensive, long topic, but yeah, I didn't want to, because we have already a lot of slides there. In a nutshell, you're going to work with a loan broker or local lender to define the best fit in terms of what's the best lending product that can be applied to your acquisition and your business plan. So you're going to ask them for a soft quote on terms. And progressively, you're going to go from all these soft quotes we discussed throughout, or estimates and so on, to finalizing all these numbers from the different sources throughout, right? So first you start with soft quote, some general terms, a couple of additional notes. If there is an existing loan on the property, it might make sense, especially these days, to assume an existing debt. If there is existing debt at interesting low interest rate, and if the property is owned outright, you may ask for owner financing. It could be a good opportunity, and it will be probably easier to work with the owner to finance the property than working with a lender. Might be much more tedious.
Paula has a question. Her question is, what is the best way to negotiate with a selling broker if you need an agency loan that takes 8 months to secure?
Competition.
Yeah, that's a tough one.
It's an agency loan that take 8 months. Do you think about a HUD,
Like a HUD loan.
like a HUD loan?
Yeah.
Well, it's all about negotiating, and you're not negotiating with a broker, you're negotiating with a seller.
Mhm.
The
Well,
broker is
yes,
the
yes.
middleman.
Yes, the
Going to
broker's the middleman.
facilitate.
Yeah.
I know one strategy is to do a bridge debt, actually, for a very short period of time. So you do a 1-year bridge loan, but that's something like the strategy to do the HUD loan. I would say your loan broker will help you define that strategy. And in that case, we would go back and forth with the seller and your loan broker and see what are the options available. But in that case, yeah, I've heard very short-term bridge debt to allow enough time to go into a HUD loan, because I'm not sure that seller will necessarily. You can always try if they understand you're going to do a HUD loan and it's going to take 8 months. Unless you put a lot of money, honest money deposit, non-refundable, they might do it. Or you could always do, what is it, like a land contract or lease? How is it called? Like basically you take over the operations before the transfer of ownership. Land contract. I think it's called a land
I think it's
contract.
called a land contract he's talking about, Adriana.
Yeah. I know about the concept. I don't know if it could be, that's another. So now you have two ideas. So bridge
Well, you
debt.
also need to consider they may go up on interest rates. We never know. So we have to have insurance for that, even if it's for a year.
Yeah, that's another.
Yeah.
That's
It's
a good
big
point.
if. Yeah.
That's a good point. Yeah. That's why I've more heard about HUD as a refinance than the first option, really. Final steps. With all the different steps that we've discussed, you put together all your numbers in your underwriting model, and that's where it's going to come together at this point. You have to think about what kind of returns are you looking for. For example, 2x equity multiple, which means 100% returns over the whole period, could be a target. That's typically what we look for. I didn't want to go, you can think about cash on cash, average return, compute the IRR, and so on. I like the equity multiple. It's very simple concept to understand. You put one in, you get two out. But yeah, define your targets. Look at your splits. How much of the returns are going to go to limited partners, to general partners. You can also, sorry for the typo here, look at the acquisition and asset management fees or any other fees. And finally, and I would say it's probably like a back and forth with those parameters, but then you can work on your purchase price to see how high you can go to achieve basically your returns. So what's the difference between limited partners and general partners? So the limited partners are the investors, And the general partners, they're going to be the managers. So if you have, particularly in the context of doing what's called a syndication, so we're going to have passive investors putting money in a deal. Legally, from the SEC standpoint, the Securities and Exchange Commission, you probably have to do a syndication, which is under rules. There's a 506B, for instance, where you can have non-accredited investors. But there's like, you're going to have to write a PPM, private placement memorandum, and use a syndication attorney to draft the documents for you and make sure that you're in line with any SEC requirement. And that's where the terms limited partners for describing the passive investors and general partners are coming up typically. An example of a general partner. Yeah, an example of a general partner is going to be like if you find a deal, you put the deal together and maybe works with one or two other people on the management team. Those are going to be the general partners. Yeah, that's my last page actually. I hope it made sense. But yeah, at that point, when you have taken all these steps, you'll be ready to make an offer.
Yep. Good job, y'all. Good job, Philippe.
Yeah, and actually, Polan and Adriana, we went together through all these steps on a recent example. Do you want to talk a little bit about that in a few minutes we have until the top of the hour, but just to say.
Do you remember how many bids were there? Go ahead.
How many what?
How many bids we were up against?
Originally, he said 24, but then he extended it for another weekend. So he probably got, I would say, close to 30. On the original 24, he said that only 7 qualify on the price that they were requiring. So
Can you talk a little bit about the property and what? Yeah.
Property was located in Fort Worth. It was 60 units, built in the 1980s. The property, when we walked the property, we realized that it had a lot of deferred maintenance, mostly water damage, just because it didn't have the proper gutters in place, which is something that it costs really little, is minimal in consideration to the repairs that now they're looking at. So at the beginning, we didn't have very little time. We only find out when the due day for the offer was like in 4 days when we find out about the property. So everything was a rush, literally. But so I guess when we made the offer was more based on exaggerated numbers because we were not able to get the person that will go with us to more of a contractor. We didn't have the time to do that. But I think it was a good experience to start everything from 1 to 100. We did spend a lot of time in underwriting. We spent probably 3 days or 4 days of about 10-hour working days with Paula. It was a lot of time consuming, but I think it was great. I think that if we can do it all over again, we wish at the end of the day, we talk to someone and this person approaches and say, next time, take me. And he's a contractor, and obviously he wants to, and they will go for Leslie. I think Leslie was talking about, how do you do that? He came and approached us. He said, next time, just take me. I won't charge you anything. Why? Because he wants to gain the business. So do I know him? Have I worked with him before? No. But he's part of a group of people that is very well known. And if he messes up, I'm sure the whole group will know. And it's a group of over 1,500 people, and it's a very well-known group in Austin. So I don't think he will do anything to damage his business. If we do it all over again, we will probably have to take someone with us. So our numbers were very extremely conservative, which I was very happy with those numbers. I felt good, and we all felt good. Philippe felt good, and Paula felt good because since we didn't really have a contractor, we were just going with new at the time. So it was a great experience. I don't know if Paula would like to add anything else. And obviously, we're trying to involve managers, but we were not able to find a property manager because a lot of the people that we were trying to contact were not taking smaller than 100 units. So that has been a challenge. On the lender side, we do have someone that she was helping us the entire way. She knows so many people. She's well connected with attorneys, accountants. So she was helping us a lot with a lot of information that we needed at the end. So being connected and having someone, especially on the lending side, that knows what they're doing and have the experience, I think is a really good thing.
Yeah.
Yeah. Anything you want to add? Anything?
Yes, I think that a couple things. When we saw the property, it's the ending of where the gutters were was actually causing the deterioration of the property. It's a simple thing. Gutters are really not, relatively speaking, they're not a very expensive expense on a property. But when you have them letting water onto the part of the property that's very expensive, it can damage a property very quickly.
Yeah.
And so that ended up to be a higher amount of noticeable damage than we had thought just in the pictures. And the pictures look pristine.
Mm-hmm.
And also their so-called best units, they were looking, trying to show us 2 units that they thought were completely renovated. I walked in those units and I thought to myself, they didn't really, if these are what they believe is renovated, they didn't repair the right things. Some of their repairs didn't match or coordinate with their own repairs. As someone who's done building before, built condos, it just didn't seem like they were designed, it didn't really coordinate. I thought they're not going to ever get, okay, they're not going to get what they think they're going to get if this is it. So we really needed more time to see. Another thing that was important is logistically, this property was across the street from a vacant lot, but the property had no pool, no amenities or space to build those amenities. As compared with properties that were immediately in the unit that even were older, that they were more updated, it would have been very difficult to compete with this property. These were townhomes versus apartments. But in today's market, what would sell? Why would someone want a townhome versus an apartment? So it'd have to be extra security. And so you have to really make use of your indoor garages. So that's another factor that we were also considering as compared to a market. You have to know the market. And we went that day and we visited 2 other properties inside to see what do they look like? What are they offering for that, the value add? It definitely made us think about what is possible in a market and to know your market. So anyway, it was a great experience. And I love to look at dirt and look at the property on hand because I think it makes a big difference in what you offer and what you can do. That's it.
Yeah, thank you for sharing.
Yep.
We're past 8 p.m. Eastern here.
I'm going to go back to the other spreadsheet.
Yeah, it's around to go too long after the hour. If you have any other question, don't hesitate to reach out. Our contact information are on the screen here. Thank you for all of you for joining, and we'll talk to you next week.
Thanks, guys. It was a great job.
Thank you, Jeff. Bye-bye.
Thank you.
Thank you so much. Thanks,
Bye-bye.
Jeff. Thanks, Philippe. Bye.